You've probably spent countless hours, right, late nights, just hunched over those glowing screens, dissecting charts, studying every single indicator, absorbing every little fragmented news headline. You've been desperately searching for that holy grail, haven't you? That one secret pattern, maybe that perfect strategy. Anything to unlock consistent profits in the market. Yet despite all that effort, all that relentless work, you found yourself baffled, maybe frustrated, just caught in this relentless kind of silent cycle of inconsistent results. Why?
Well, what if the true unseen barrier to your trading breakthrough isn't external at all? What if it's not out there in the market data, or some hidden algorithm? What if it's something hidden deep within your own mind, something you've probably never been told? Maybe forbidden truth, something suppressed for decades.
Yeah, get this. Here's the shocking, almost brutal revelation buried deep inside Mark Douglas's seminal work, Trading in the Zone. The very skills, the very disciplines that have made you successful in, like every other area of your life, your meticulous study, your careful planning, that cautious risk aversion, these are precisely what often sabotage your trading. This isn't just bad luck or, a flawed strategy. It's about a deeply ingrained psychological conflict, a war being waged right inside your own head. And it almost guarantees failure for the vast majority who even dare to step into these markets.
Douglas, with really unnerving precision, uncovers exactly why over 95% of traders fail consistently. And this isn't some abstract theory, okay?
Yeah.
This is a brutal, undeniable reality he just dissects, revealing a secret almost nobody dares to talk about in, let's say, polite trading circles.
Yeah.
And it will absolutely force you to look inward.
So we're going to peel back the layers today. We're going to expose these profound psychological forces that just invisibly dictate your trading outcomes. You'll discover why your desperate, almost primal need to be right, why that's actively destroying your profits. You'll see what the market truly is from the chilling perspective of the consistent winners, the elite few who actually walk away with the money.
But that's not even the craziest part. Honestly, there's one profound truth buried deep within this book, a single, really unassuming line that could redefine your entire approach to the markets. And frankly, maybe your life. That line is waiting for us. It's the ultimate paradox, you see, the final key.
Don't go anywhere, because this changes everything. Welcome to The Deep Dive, the place where trading's forbidden truths are exposed. Today, we're plunging into Mark Douglas's Trading in the Zone, drawing only from its pages to reveal the unseen mental barriers holding you back. Our mission, it's to arm you with the psychological tools that unlock consistent success, and maybe show you why you might just be your own worst enemy in this game. Okay. Let's unpack this. Our journey into Douglas's work, it really begins by demolishing what he calls the trading myth, which is, these deeply flawed assumptions about how markets actually work, and maybe more importantly, how we as humans are expected to interact with them. Just picture yourself back in the late 1970s, the established dogma, right? The prevailing wisdom on Wall Street was that fundamental analysis was the only truly rational way to make trading decisions.
What's truly fascinating here, though, is the sheer, almost unquestioning faith that was placed in these complex mathematical models, in spreadsheets just bursting with economic variables, things like interest rates, intricate company balance sheets, even the subtle shifts in weather patterns for commodities. The belief was rigid. If you just crunched enough numbers, you could precisely project where a price should be at some future point. It was all about prediction. But Douglas reveals the critical, almost comically tragic flaw in this logic. These sophisticated models never factored in other traders as variables. Not their fears, not their greed, not their sudden, irrational impulses.
So what does this all mean for you listening right now? It's a brutal, kind of disorienting truth. Prices move because people, driven by their beliefs, their expectations, and their raw, undeniable emotions, make them move. Not because some pristine spreadsheet or economic model dictates they should be at a certain level.
Exactly. And Douglas saw this firsthand. He noted that even floor traders, the guys who literally stood in the pits, moving vast sums of money, they often lacked any deep fundamental understanding. They acted on gut feelings, on the sudden shifting flow of the market, on pure visceral emotion, completely outside the parameters of any logical mathematical model.
Right.
This created a profound, really dangerous reality gap between what should be, according to the math, and what is, according to, people. The market, cold and indifferent, just didn't care about your logic.
And that reality gap, it was a silent killer, wasn't it?
Absolutely. It meant that while a fundamental analyst might, eventually be proven right about some long-term price target, the sheer volatility, the wild emotional swings in the meantime, made it virtually impossible to stay in a trade long enough to actually profit from it. People were getting absolutely crushed, financially and psychologically, just waiting for the market to act rationally. Their intellect told them one thing, but their emotions, driven by the unpredictable chaos of all that human behavior, well, they told them something else entirely.
So this is the first really vital crack Douglas exposes in that whole foundation of traditional market thinking. It's just flawed.
Then came this seismic shift. Technical analysis started emerging from the shadows.
Right, and it was scoffed at, wasn't it? Dismissed at first as just mystical hocus pocuses by the old guard, the established institutions.
Yeah, exactly. But the technical traders, they knew something the mainstream didn't, something they had observed on the trading floors for generations, really. A truth kind of whispered amongst the savvy few.
So what was that truth? What did they see?
Well, if we connect this to the bigger picture, technical analysis recognized a profound, almost primal truth. That individuals and groups of individuals interacting day after day, they form observable, quantifiable, repeating behavior patterns.
Oh, okay. Patterns in the chaos.
Precisely. It shifted the focus from those external economic factors, which were largely irrelevant in the short term, right, to the internal predictable dynamics of human psychology within the market itself. It turned the market from this unpredictable, chaotic beast into, as Douglas puts it, an endless stream of opportunities by identifying these statistically reliable, emotionally driven patterns.
Okay, so that sounds like the answer, right? Problem solved. The technical analyst could get into the mind of the market, anticipate what was likely to happen next based on these historical patterns. With all these endless opportunities, surely consistent profits would follow. Finally.
You'd think so. But then the crushing reality hit. The profits still weren't consistent. The vast majority of traders, even those mastering technical analysis, they still struggled. They still lost money. Why?
So there's another gap.
Exactly. This brings us to the real insidious problem Douglas identifies, a profound psychological gap that technical analysis, despite its brilliance, just couldn't bridge. You could master every chart pattern, every indicator, predict a market's movements with uncanny accuracy, yet still fail to translate that knowledge into consistent profits.
And this is where it gets personal, right? This might sting a little because that psychological gap, it points directly at you.
Yes. It's not the market. It's your mind.
Yeah.
And the deeper we go here, the more unsettling this truth actually becomes. So if it's not the market analysis, if it's not the charts or the news, what is it? What's the real barrier? Douglas posits that the market offers, well, unlimited possibilities. Just think about it for a second. 8 billion bond spread combinations.
8 billion. Wow.
8 billion. This boundless freedom, this potential, is precisely what attracts so many to trading. This seductive promise of infinite wealth, a life without limits, a life completely free of external constraints.
But here's where it gets really interesting and profoundly dangerous. That very freedom, that shocking lack of boundaries, it's also its greatest danger.
Exactly. Douglas explains that very few people are properly equipped psychologically for an environment with so few boundaries. An environment, as he says, where the potential to do enormous damage to ourselves exists.
Okay, but why? Why does unrestricted freedom, something we crave more than almost anything, actually lead to consistent failure for most people? What's the dark irony there?
It's a paradox, isn't it?
Yeah.
And it forces us to confront the deepest layers of our upbringing. Our societal condition, from the absolute moment we're born, it clashes violently with the market's true nature. From our first breath, we're taught rules, restrictions, boundaries. We're constantly shaped by external control, by the commands and prohibitions of others.
This raises an important, almost chilling question then. Think about that vivid example Douglas uses, the toddler reaching for the fragile vase on the coffee table.
Right. The child is just compelled by natural curiosity, an inner-directed force to explore, to touch, to experience.
But then, boom, a sudden sharp scream from across the room. No! Don't touch that.
Yeah, the child is startled, falls back, probably starts to cry. It's a seemingly innocent, unavoidable interaction. But its impact, it's profound. It resonates.
So how does that connect?
By the time we're 18, Douglas argues, we've accumulated thousands of these denied impulses. Thousands. Moments where our natural inner-directed expression was suppressed, redirected, maybe even punished. These denials create deep mental vacuums and reservoirs of emotional pain.
Wow.
Thousands.
And Douglas describes how crying is actually a natural reconciliation mechanism, like nature's built-in way of expelling this negatively charged energy. But society often suppresses it, right? especially in boys, teaching them to be strong, to man up.
Yeah, definitely.
This leads to these unresolved impulses, this raw, unreconciled energy, manifesting as deeply ingrained addictive and compulsive behavior patterns in adulthood. Think about that. The very act of growing up in society can actually predispose you to self-sabotage in the markets. It's baked in. So these unresolved impulses, this unreconciled energy, they aren't just abstract ideas. They're silent, invisible saboteurs lurking right there in your mental environment.
Absolutely. They are actively working against your trading account without you even realizing it. They make you instinctively resist the very mental structure, the very discipline you desperately need to succeed.
And wait until you hear how they make you resist the one thing that could actually save you.
This internal struggle, this deep-seated psychological baggage, it manifests as what Douglas identifies as the trader's most critical problems, the silent killers of consistent profitability.
Okay, let's break those down. Problem 1, the unwillingness to create rules. This sounds like a devastating paradox.
It is. Most traders logically agree that rules make perfect sense. They understand intellectually that a defined system with clear entry and exit points with disciplined money management is crucial, yet they resist creating them. Or maybe more often, they create them only to follow them inconsistently, bending or breaking them just this once. Sound familiar?
Definitely. But it's not laziness or lack of intelligence.
No, not at all. Douglas says this is a deep-seated, unconscious resistance to anything that feels like it's denying our freedom. It stems directly from those thousands of childhood denials, that accumulated negative feeling of being told no when our inner impulse screamed yes.
Ah, okay.
The sheer volume of these negative feelings acts as a powerful, unseen force inside our minds, causing us to resist anything that tries to limit our perceived freedom to do what we want when we want, especially in an environment like the market that literally has no boundaries. It's like a subconscious rebellion against structure itself.
Wow. So Douglas states it usually takes a great deal of pain and suffering to break down this ingrained resistance.
Yeah. You often have to hit rock bottom, suffer significant financial and emotional losses to force yourself, finally, to establish a disciplined, organized trading regime with prudent money management guidelines. You literally have to suffer enough to break free from your own conditioning. The pain has to become so great that it outweighs that unconscious pull of false freedom.
Okay, what's next? Problem 2, failure to take responsibility.
Right. Trading is the purest form of personal choice imaginable. Nothing, absolutely nothing happens until you decide. You initiate the trade. You choose when to end it. You set the parameters. It's all you.
Yeah. How many traders truly genuinely accept complete responsibility for every outcome, especially the losing ones?
Exactly. Most will intellectualize it, sure. Yeah, it's my fault. But deep down, the finger points outward.
And the key here is the insidious allure of what Douglas calls random trading. Trades that are poorly planned, unorganized, impulsive, defying any systematic approach.
It's so easy, isn't it? So seductive to take credit for wins, believing some method was present, maybe a stroke of genius, and then just as easily blame losses on some variable I didn't know about, or bad luck, or the market makers were out to get me. We've all heard those.
Yeah, it lets you off the hook.
It does, but it allows you to sidestep the painful yet utterly essential feedback loop that is the bedrock of real learning and improvement. It just keeps you stuck in the same loop.
Douglas calls the market a zero-sum game. Your gain is another's loss. He states profoundly, any degree of blaming means you have not accepted the reality that the market owes you nothing.
And that's key. Blaming the market creates this adversarial relationship where you perceive it as being against you, like it's personal.
But it's not fighting you.
No, it's simply a reflection of collective action, just a flow of energy. This illusion of external control of the market being some kind of opponent keeps you from learning what you actually need to learn about yourself. It creates a psychological trap.
Okay, this next one sounds chilling. Problem 3, addiction to random rewards.
Yeah, this is a truly chilling insight into the human psyche, a dark truth about how our brains are wired. Think about those monkey studies Douglas references. If you train a monkey to do a task and consistently reward it, it learns quickly, predictably, and crucially, it stops when the reward stops. Makes sense.
Right.
But if you reward it randomly, that monkey keeps going indefinitely, hitting the lever, pulling the chain, even when the reward completely ceases.
Why? That seems crazy.
Because the unexpected, surprising nature of the reward makes it profoundly, overwhelmingly addictive. It literally overrides all logic.
And what's truly unsettling here is how random wins in trading that unexpected electrifying surge of euphoria when a poorly planned, impulsive trade just explodes into profit, how that can be profoundly addictive for us humans, too.
Exactly. It floods your brain with feel-good chemicals, a huge rush of dopamine, overriding other crucial needs like the need to protect your capital or the need to stick to your plan. You feel choiceless, compelled to continually chase that random high, that unpredictable hit. It makes you ignore the devastating long-term consequences of your impulsive, unsystematic behavior. It's a hidden, insidious force working against you.
So this addiction to random rewards is just silently, relentlessly sabotaging the very mental structure you need for consistent profitability.
Yep. You're compelled, against your own best interests, to chase the unpredictable, the lottery ticket, rather than embrace the systematic, probabilistic approach that actually generates wealth over time.
But what happens when you try to apply the external control you've learned your whole life, the manipulation, the influence? What happens when you try that in an environment that simply doesn't care? An environment that is utterly indifferent to your desires.
Which leads us to problem 4, external versus internal control. We are programmed, hardwired, for social environments. Our entire upbringing teaches us to control and manipulate others to get what we want right, to influence our surroundings, to bend the world to our will.
But the market, it's a psychological wilderness, as Douglas puts it. It's a mirror, sure, but it's also an indifferent void.
The market doesn't know, care, or respond to what's important to you. It has no obligation whatsoever to fulfill your expectations, your desires, your hopes, or your dreams.
It's truly every man or woman for himself or herself, a brutal, indifferent arena.
You can't control the market any more than you can control the tide, or the weather, or the movement of the stars. It simply exists. It flows.
So the solution isn't to force the market into submission, not about manipulating external forces or trying to predict the unpredictable actions of millions of other traders.
No. The solution, the only path to consistency, Douglas argues, is to control ourselves, our perception and interpretation of information, and crucially, our own behavior.
And that's the profound, terrifying freedom he talks about, isn't it?
Yes, because it means the source of your problems and the ultimate source of your success lies entirely within you. And that, well, that can be a very bitter pill to swallow.
Okay, Douglas makes this powerful, almost unsettling claim, one that really shatters illusions. The market doesn't create your attitude or state of mind. It simply acts as a mirror, a pure, unbiased reflection of what's already inside you, back to you.
Exactly. So if you're experiencing anger or fear or frustration or that paralyzing anxiety, it's not because the market is doing something to you. It's because you believe deep down that the market controls your outcomes.
True confidence, then, the kind that consistent winners seem to possess, the kind that feels almost effortless. Where does that come from?
It comes from an unshakable belief that you are completely responsible for your results. Every single outcome, good or bad, every tick, every swing, is a perfect, undeniable reflection of your own beliefs and choices. This radical acceptance, it allows you to constantly learn, to adapt, to grow, and to remain in the flow of opportunities instead of being paralyzed or blinded by external events. It allows you to become one with that flow.
Okay, but how do you escape that vicious cycle of blaming the market, especially when it feels so real, like it's actively conspiring against you, like it's picking your pocket? Douglas reveals the core psychological hurdle here, right? And it's something you might not want to hear.
Yeah, think about this. Why is leaving money on the table often more painful, more psychologically damaging than actually taking a loss?
That's interesting. Why?
Well, when we take a loss, our minds, conditioned by societal norms and self-preservation, can often find a convenient way to shift the blame to the market. It was a bad market. The news moved against me. I couldn't have known about that black swan event.
Right.
We externalize the pain. We create a narrative that lets us off the hook.
Right, makes sense.
But when we miss a winning opportunity, when the market gives us exactly what we wanted and we fail to act, the blame is solely, undeniably on us. There's no escaping that pain, no rationalization, no external entity to blame. It's a pure, unencumbered confrontation with our own inaction, our own flaws, our own deeply embedded fears. It hurts more because it's us.
And this brings us to the central paradox of trading, maybe the single most important skill you can ever learn. How do you accept the inherent, undeniable risks of trading without that emotional discomfort, without paralyzing fear, without hesitation?
Douglas says most traders assume they accept risk. They pay lip service to risk management, with stop losses and position sizing. But emotionally, deep down, they absolutely resist the possibility of being wrong, of losing money.
So if you haven't truly emotionally accepted the risk, the potential to be wrong, lose money on any single trade, or miss out on an opportunity, what happens?
You will unconsciously, invariably avoid it. You will hesitate. You will move your stop loss further away. You might double down on a losing position. And trying to avoid the unavoidable, the inherent risk, leads to disastrous effects on your discipline, your profitability, and your mental state.
Fear immobilizes the mind.
Completely. It literally blocks other possibilities, making perfectly valid opportunities invisible, blinding you to the truth of the market in that moment. Douglas states that learning risk acceptance, true, visceral acceptance, is the single most important trading skill. Period. It's the only way to achieve an objective perspective, not skewed or distorted by fear, allowing you to trade without hesitation, without all that emotional baggage.
And this fear, this deep-seated resistance to risk, it's profoundly rooted in our mental software, isn't it? Recall Douglas's chilling story of the boy and the dog.
Right. A single traumatic experience with one aggressive dog can lead to a lifetime of irrational fear of all dogs, even the friendliest, most gentle ones. The mind just creates this powerful, unseen wall.
How does that illustrate the trading mind?
It vividly illustrates how our minds automatically associate similar characteristics. Our minds link now-moment information, like seeing a new chart pattern that looks like a previous loser to past emotional experiences, like the pain of that loss. This structured energy in our minds, particularly negatively charged energy from pain and trauma, can make opportunities literally invisible if they're linked, however tenuously, to past negative outcomes.
And we don't consciously choose this.
No, it's an unconscious mental function, as automatic and unthinking as your heartbeat. Our minds block, distort, or diminish information that threatens our existing beliefs, trying to keep us pain-free in the short term, but ultimately cutting us off from the flow of opportunity, from the flow of money. It's a tragic self-preservation mechanism that backfires spectacularly in trading.
So when you hesitate on a trade, or when you let a winner turn into a crushing loser, or even when you jump into an impulsive trade, it's not the market doing it to you.
No, it's your own mind, trying to protect you from perceived pain based on deeply ingrained past associations, blinding you to the unique now-moment opportunity. It's like a shadow operating within you, pulling the strings.
Okay, so if there's one core secret then, one profound transformative truth at the heart of Douglas's philosophy for trading without fear or overconfidence, what is it?
It's this: a powerful, unshakable belief in an uncertain outcome with an edge in your favor. That's it.
An uncertain outcome with an edge. That belief sounds revolutionary, like the ultimate mental hack.
It is. It actively prevents your mind from automatically associating the current now-moment situation with the emotional outcomes of your most recent trades, whether they were wins or losses. It frees you from unrealistic and rigid expectations about how the market will express itself next.
So instead of generating those expectations that inevitably lead to emotional and financial pain,
You learn to make yourself available, as Douglas says, to take advantage of whatever opportunities the market may offer in any given moment. You become a neutral observer, a pure executor of your plan.
Douglas posits that the best traders don't need to know what will happen next. They don't try to predict the future.
Exactly. Because they know it's impossible. They only need to trust their edge, their statistically probable advantage, and trust that probabilities will play out over a series of trades, not just one. They embrace, fundamentally, that any single trade is uncertain. And this is the absolute crux of the casino analogy.
Ah, yes, the casino analogy. It's incredibly powerful, isn't it? Almost chilling, undeniable truth.
It is. Casinos make consistent, enormous profits day after day, year after year, from events like blackjack or roulette, which have purely random outcomes on any single instance.
Right. There's no skill in a single roulette spin, so how?
Because they understand probabilities at two crucial levels that you must internalize if you want to succeed like they do.
What are those two levels?
Okay, so at the micro level, each individual hand of blackjack or spin of the roulette wheel is uncertain. There are unknown variables, random chance, that make each outcome random relative to the last or the next one.
Okay, micro level.
Random.
Right.
But at the macro level, over a large sample size, thousands, even millions of events, the outcome is predictable and certain due to their inherent edge, the unwavering rules of the game that favor the house.
Macro level, a certain edge.
Exactly. Casinos commit to participating in every event relentlessly, knowing their edge will play out over time. They don't get emotional about one loss. They don't bet the house on one spin. Traders must apply this exact same strategy. You are the casino. Your trading system, your edge, represents the house rules.
So Douglas explains that any edge you identify, whether it's a technical pattern, a fundamental insight, whatever system, it only provides favorable odds, it just shifts the probability slightly in your favor.
Precisely. But the outcome of any single trade is inherently uncertain because of all those unknown variables, the unpredictable, constantly changing behavior of all other traders in the market.
Millions of them.
Millions. Each now moment in the market is unique, a fleeting interaction of countless individual psychologies, beliefs, and fears. It only takes one person, one big player, to change everything.
Which brings us to that story from the book, the one that vividly illustrates this brutal, unforgiving reality. It's chilling.
Oh yeah, it's a tense scene, almost cinematic. Douglas recounts this brilliant technical analyst, absolutely filled with the intellectual certainty of his craft, sitting with the semi-retired chairman of a substantial brokerage firm. Now, this chairman was a veteran floor trader, nearly 40 years of brutal experience in the Chicago Board of Trade grain pits, real old school.
Wow.
The analyst was explaining his point-and-line method, a system that could supposedly define support and resistance levels with precision. He had projected a major support point in the soybean market, confidently declaring it would be the low of the day.
So they watched the market slowly, inexorably trend down to that precise, mathematically defined price point.
Yep. And the analyst, just brimming with intellectual certainty, reiterated, absolutely, this is the low of the day. It's proven. The chairman, this grizzled veteran who, as Douglas notes, didn't know much about technical analysis because he never needed it to make money on the floor, simply stared at the screen, a grim smile playing on his lips. Then, with this chilling, almost casual calm, he just retorted, "That's bullshit."
Oh, wow.
The chairman then picked up the phone. His voice, steady and deliberate, cut through the tense silence of the room. "Sell 2 million beans at the market."
2 million, just like that.
Just like that. Within 30 seconds, which feels like an eternity in trading, the price of soybeans plummeted a full 10 cents a bushel. Crushed that support level. He then slowly turned to look at the horrified, wide-eyed expression on the analyst's face. Calmly, he asked, his voice laced with this cold, hard truth. "Now, where did you say the market was going to stop? If I can do that, anyone can."
That anecdote, a single brutal moment, it just lays bare the undeniable, unsettling truth, doesn't it?
It really does. It only takes one other trader anywhere in the world with a different belief, a different agenda, or just enough conviction and size to act, to completely negate your edge, to shatter your perfectly logical analysis, to turn your certain outcome into pure chaos.
That is the inherent, inescapable uncertainty of the markets. That's the true psychological wilderness.
Yes, but the question remains, how do you train your mind, your very being, to accept this level of uncertainty without paralyzing fear, without letting it destroy your trading discipline, your capital, your very future?
That's the core, isn't it? The deepest secret of Douglas's work.
So, the path to consistent success in trading, it's built on this profound paradox, one that goes against every instinct ingrained in us by our society, by our very nature. You must be rigid in your rules and flexible in your expectations.
Rigid rules, flexible expectations, but most traders, tragically, do the exact opposite, right?
Exactly the opposite. They are flexible with their rules, bending or breaking them on a whim, driven by impulse or fear. And they are rigidly, stubbornly fixed in their expectations, clinging desperately to what they want the market to do, blinding themselves to the reality unfolding right in front of them.
So rigid rules are your safeguard, your unbreakable shield in this boundaryless environment.
Yes. They build self-trust. They build self-protection. They prevent you from succumbing to impulse, from that constant self-sabotage.
And flexible expectations.
Flexible expectations allow you to perceive market information objectively, without being trapped by what you want to happen or what you think should happen based on the past. Think about it. If you enter a trade expecting a specific outcome, any deviation from that expectation is instantly interpreted by your mind as pain, triggering your deep-seated defense mechanisms.
Causing you to exit too early, maybe hold too long, make mistakes.
Exactly. You're reacting emotionally, not objectively.
Douglas reveals this crucial, almost liberating truth about self-discipline, too. It's not some innate personality trait you're born with, not some magical gift only given to a select few.
Not at all. He says it's a mental technique, a conscious, deliberate process to redirect your focus when your desires conflict with your existing, often self-sabotaging beliefs. It's a skill you can build. You must build.
And he shares his own powerful, deeply personal story about becoming a runner, doesn't he?
He does. When he first started, he couldn't run more than 50 or 60 yards without collapsing. Just couldn't do it. The conflicting thoughts were overwhelming. This relentless internal barrage is too hot. I'm tired. Nobody else is doing this. This is pointless. You know the voice.
Oh, yeah.
He didn't initially have the physical stamina and certainly not the mental fortitude. So he set a clear, unwavering goal to run 5 miles by the end of the summer.
And his critical insight was what he called the 5-mile rule.
That's right. He committed, absolutely and without compromise, to running at least one step farther each time he went out. No matter how little, no matter the excruciating internal resistance, the screaming voice telling him to stop.
Just one more step.
Just one more step. It was a relentless, conscious redirection of his focus, pushing past the pain, past the doubt, past the ingrained desire for comfort. Douglas describes how this consistent, unwavering application of self-discipline, by continually redirecting his focus and pushing past those conflicting thoughts, it built new supportive beliefs about himself as a runner. Over time, this drained the energy from the conflicting beliefs, from that internal resistance, eventually leading to effortless action. He eventually ran regularly for 16 years, not because he was naturally gifted, but because he deliberately practiced mental discipline.
Wow. That's the power of conscious self-discipline, then. It's how you actually build new mental structures.
Exactly. And this leads us directly to what Douglas calls the mechanical stage. This is the crucial, non-negotiable starting point for any truly consistent trader.
And it's not about making money initially.
No, not really. It's about building yourself. It's where you build the unshakable self-trust necessary to operate in an unlimited environment. It's where you learn to flawlessly execute a trading system without deviation. And it's where you finally train your mind to truly think in probabilities, to internalize those 5 fundamental truths Douglas lays out about market reality.
So this stage is about actively installing core beliefs deep into your subconscious. Beliefs like, I objectively identify my edges and every moment in the market is unique.
Precisely. These beliefs directly counteract our mind's natural destructive tendency to associate the present with past pain, to see threats where there are only probabilities and opportunities. You are actively, deliberately debugging your mental software. You're reprogramming your operating system for consistent profitability.
Okay, so consistent success means eliminating errors, reducing self-sabotage to 0. But most people, due to past negative experiences, actively avoid acknowledging mistakes, don't they? They hide from them, rationalize them, just ignore them. That sounds disastrous in trading.
It is. We're conditioned, aren't we, to see mistakes as something to be ashamed of, something to hide, a sign of weakness or failure.
But look at great athletes, elite performers at the pinnacle of their game. How do they view mistakes?
They aren't afraid of them. They don't dread them. They see them as natural signals, as undeniable guideposts, pointing the way to where they need to focus their efforts to grow and improve themselves.
So mistakes are just feedback.
Exactly. Just neutral information. This profound shift in belief allows them to move past errors quickly, without self-criticism, without taking emotional damage, without carrying the psychological baggage that destroys most traders. They learn and adapt relentlessly rather than stagnating in regret or fear or self-loathing. It's a radical shift in perspective that unlocks true exponential growth.
Which makes you wonder, what self-sabotaging beliefs might you unknowingly hold deep in your subconscious that are causing you to repeat the same trading errors over and over again?
Are you unknowingly punishing yourself for past perceived unworthiness? Or maybe even for the easy money you made when you first started, before you really understood the hidden game?
We'll unveil the final, most unsettling truth about this in the last segment.
But first, to integrate these truths, to begin this profound mental reprogramming, Douglas provides a concrete, almost Spartan exercise, a literal roadmap to changing your mind, to forging your new trading self.
Okay, what's the exercise?
You choose any precise, objective trading system, any set of variables that define an edge. It doesn't have to be the best system in the world, remember. The point isn't immediate profit, it's internal transformation. The system must be absolutely precise, requiring no subjective decisions, no gut feelings, no maybe just this once, purely mechanical.
Then you commit to trading at least 20 occurrences of your edge, without deviation, without judgment, regardless of individual outcomes.
You don't try to pick or choose which ones look like they'll work. You simply execute every single one that meets the criteria.
And the goal isn't to make money initially. It's to train your mind to operate exactly like a casino.
Exactly. Knowing that over a sample size, over a series of events, your edge will play out. Even if individual trades are random, even if they're losses, you become the house. You trust the probabilities.
And before you even begin, you must define your risk for every trade. Have a profit plan. Understand your expected win-loss ratio beforehand.
Absolutely critical. This practice forces you to deactivate those internal conflicts, those hidden fears, and builds the necessary mental structure, brick by painful brick sometimes. It's like a mental boot camp, really.
Yeah.
A crucible that will reshape your mind into that of a consistent winner if you stick with it.
Douglas notes that this exercise will likely create a head-on collision between your desire to think objectively in probabilities and all the forces inside you that are in conflict with this desire.
Yeah, don't be surprised if your first attempts feel virtually impossible. If the internal resistance feels overwhelming, that's normal. That's the conditioning fighting back. But the consistent effort, just like his running, will eventually create effortless action, automatic discipline, and a profound mental freedom that unlocks consistent profits. It takes work.
Okay, so we've dug deep. We've explored how your past conditioning, your natural primal desire to be right, and that seductive, crippling illusion of external control are actively, ruthlessly working against your trading success.
And you've seen how taking complete, unencumbered responsibility and truly thinking in probabilities are absolutely critical, paradigm-shifting changes in mindset, foundational changes.
But here's the real mind bender, the ultimate paradox. The profound truth, Wall Street, the institutions, the noise traders, everyone who profits from your losses, hopes you'll never figure out.
That is it. The single line, the final key that will force you to rethink everything you thought you knew about mastering the markets. Are you ready?
Lay it on us.
To consistently win, to achieve true profitability and unshakable peace of mind in this chaotic, indifferent environment, you must utterly surrender the need to know what will happen next. You must believe, without a shadow of a doubt, in uncertainty.
Wow. Surrender the need to know. Believe in uncertainty.
You cannot predict the next tick. You cannot predict the next move. You cannot predict even the outcome of your very next trade with certainty. It's impossible. But your mind, conditioned for certainty, for control, for being right, struggles violently with this fundamental truth. It fights it tooth and nail.
And this is what Wall Street hopes you'll never figure out.
This is it. That the true perfect trade isn't about knowing the future. It's not about being right or having some magic crystal ball. It's about a state of mind. It's about having a mental operating system that allows you to flawlessly execute your edge, your system, without hesitation, without emotion interfering.
It's about accepting whatever outcome occurs, win or lose, and moving on immediately, without emotional damage, without regret.
Knowing, with absolute certainty built over time, that the probabilities are on your side over a series of trades.
So your emotional pain, your frustration, your bad luck, it's all self-generated.
Yes, a brutal reflection of unaccepted risk and rigid, unrealistic expectations. The market simply is. It flows. It is your beliefs and your beliefs alone that determine your experience of it.
This is the ultimate freedom then, and maybe the greatest challenge you will ever face as a trader.
To surrender the illusion of control and to embrace the cold, hard, liberating reality of probability, this is the secret Douglas reveals. This is Trading in the Zone.
If you found this dive inside Trading in the Zone valuable, if it opened your eyes to a deeper truth, make sure to hit that subscribe button and join us here at The Deep Dive, where we decode the market's deepest secrets, one legendary book at a time.